All right, thank you very much. Just a quick check. Nitesh, are we live on YouTube? 2 minutes. We're live. Okay. All right. Welcome all of you once again. This is a product reveal. Bata do 3B, building number 3B. 3A, 3B. Welcome once again. This is the product reveal program by 2Cents Capital. We started this approximately a year and a half back. Around 40 people came together roughly 12 months back with an objective in mind, and we are going to discuss a little bit about what we have tried to achieve in the last 1 year of working together, and maybe you guys will like what we have done. We'll also give you a little bit of a glimpse about what's under the hood of how we are doing these things, and slight introduction about where we want to go from this point on. So very quickly, we all gathered roughly a year and a half ago, with a mission that we would bring certain financial products which are A, high-tech in nature, and B, not available at all in India, and we would want to do that with the best people, best team in place. We would want to completely automate the process and make it at the cutting edge, and not just for the heck of it, but in its real, true sense. So with that mission, what we decided to do was, we said we will make these products available to all. For some reason, all of these products, as far as we have seen, are not available to most of the investors in India, and you will see how. And that is what brought us together, and that is what we have been doing for the last roughly a year and a half, 18 months. All right, so we decided what are the foundational things that we want to be known as. And we said we want to be known as people who are very good with maths. And when I say maths, I am not just talking about simple maths. These are pretty complicated stuff. Then we want to be very good at tech, which means we want to automate everything, and that can only happen at the back of a very good code system and infrastructure, so on and so forth. And we are all very passionate about finance and the things that it can achieve. Now, when all of these three things became a part of our objective or the roots, we said, okay, now we need to put together a team. And we said we are going to put together a team which will be called quants. Now, quants are nothing but, I mean, this is a term which is very well known outside of India. It is catching a lot of fancy in India these days. It is nothing but a combination of people who can do finance using tech and maths. With that in mind, we put together around a 40-member team, mostly computer science engineers because we needed a lot of tech, 3 senior portfolio managers, 5 AI ML engineers, 8 quantitative finance. Again, this is a confluence of finance and mathematics. 7 risk managers, again, who are very good with maths as well as tech, and 4 data scientists. Now, that is the kind of skill sets we brought together with the 40-member team that we put together. And the way we thought we are going to do this is we went to all the IITs or XITs and we sourced it from them. It was easy, it was expensive, but it was easy to do because then we knew the kind of skill sets that we were choosing or we were going after. And the initial team of 4 or 5 people we were very pleasantly surprised with what we got in terms of skill sets in maths, finance, and tech. Now, so these are some of the interviews that we conducted when we were recruiting. It was a 3-day session. We called people in Chennai, present IITians, ex-IITians, so on and so forth. We did a session in Delhi and we did a session in Bombay. So we basically sourced people from these 3 cities, but they cut across various IITs. We have around 5 people from IIT Kharagpur as well, and you will get to know them as we go along. One thing that was, so we had the examination session we thought was very rigorous. There was a 3-hour session on absolutely high-end mathematics, a 3-hour session on what we thought was a very difficult coding exercise, and a 3-hour session on a finance question which involved coding as well as maths, spread over 2 days. Now with all of that, we came up with a few products that this all culminated in. The first product was the foundation on which everything is built. It's the tech platform. We call it the Synapse. You will know a little bit about what goes into the Synapse. And the people who are building Synapse, I had the misfortune of interviewing them. I'm from IIT Delhi. My GPA was 5 point something. 2 of these guys in the team are 10-pointers. I interviewed them. So it was, I told them that, look, I have no locus to be interviewing a computer science guy, 9.8 and a 10-pointer, when I myself was a 5-pointer from the same college. But anyway, so that's the Synapse that is being built. If I were to summarize, BlackRock has something called Aladdin. That is what we are chasing. Whether we reach there, not reach there, that will be decided, but we have put together a good team, what we think is a fantastic team, and we are on the correct trajectory. Then there is a separate team for risk management. We have seen this, and this is very cliched. This is extremely important. We take it very, very seriously. There is a separate team of 4 people, CFA, FRM, IITians, who only handle this one piece. And then you have a few products which are not very prominent in India. One of the products, and we will talk about it in one of the sessions today, is called structured product. Just to give you a glimpse, structured product market is approximately $2 trillion market globally. In India, it is hardly anything. I would say around 30,000 crores, so you would say around 3 billion or a 4 billion market in India. So it is kind of negligible, and there is a reason for that. The biggest reason being the capital convertibility restriction that India had put in place, which prevented any conversion into US dollar beyond 25,000. 5 years back, that has been relaxed. The new capital convertibility limit is $250,000 per person per year. And that is what is going to fuel the proliferation of structured products in India, because this is a product worth being in every individual's portfolio or maybe a consideration, and it currently is not, and the data tells you the number. There is a team which specializes only on this, and they will make a presentation of what exactly is this and how can an Indian investor seek to consider this as in their portfolio. Then we did fixed income. Again, globally, fixed income market is a very prosperous market. The bond market in India is non-existent. The reason being the limit was around 20 lakh rupees, and there was no, and even if you invested 20 lakh rupees in a bond and you wanted to get out, there is no market that you could get out from. Indian government has taken steps which indicates that going forward, this market is going to become big in India. Globally, a fixed income bond market is 5 times bigger than the equity market. In India, it is non-existent. In India, the government now has put a new regulation which allows for a 1 lakh rupee investment. This will lead to a lot of marketplaces and proliferation. We have already started seeing some players doing this, but we have a long way to go. So that's the second product that we'll be focusing on. Third is we allocate a certain portfolio to quant trading, and this is something like a prop, and we do both delta 1. Delta 1 means instruments which move 1:1 ratio, like currency, gold, so on and so forth, as well as we do futures and options. A $3 trillion market cryptocurrency is kind of non-existent in India. The reason again is lack of regulation or lack of clarity of regulation on this field, tax implications, KYC regulations, so on and so forth. We think we have found a solution, and the crypto team will talk a little bit about that solution. In this field, in India, we already have a very good portfolio running outside of India. In India, we have solved the logistics problem, and the guys will also talk about what kind of investments we do in the cryptocurrency avenue. And should anybody be interested, we'll be happy to take more questions on this front. Last but not the least, there is a separate vertical called long-term equity, which practices a method called quant. Globally, like I said, this is a very common, has been happening for the last 20 years. In India, I think there is only one mutual fund which we thought was doing long-term equity investment through a quant method. We intend to, I mean, we're not pioneers in this, but we intend to follow that same methodology, I mean the quant methodology, to build a long-term equity. It is a much enhanced and a much better way of investing in long-term capital, and there is a team which will explain to you how this quant long-term equity works. Trust me, you will be amazed by what a computer can do. A human can never even think of doing or coming close to what a code or a machine learning can do. They can analyze parameters which is unthinkable, unimaginable. And that is probably what the task of the team which does this, and I think they will be up next, to explain how they do the quant long term. They will probably go a little bit below the hood to explain the various steps that goes into quant long term equity investments. All right, so those are the 5 products, and we have a fund registered outside of India. We have an AUM of approximately $30 million as we speak. But the beauty about this product is, today let's say the long-term equity. The long-term equity product currently runs on an index called Morgan Stanley Value Index. If we remove the long-term, the Morgan Stanley Value Index, and we put some nifty value index, we do some bit of optimization, we can actually start a fund in India. The only thing that is stopping us to do is the license, which we have applied for. In 3 to 4 months, we'll have a license. Our same strategy, which has been running in the US market for approximately 6 to 7 months, can be replicated with minor adjustments to the Indian market. This is point 1. This is true for every product that you see. Second, because this is completely tech, I can run one software on our hedge fund account, and I can run the second instance of the same software in your Zerodha or IBKR, whatever account you have for equity investment. We will be called PMS. The same product, tech, runs multiple instances, is called PMS. We can take the same product, run it in Saudi Arabia. We also have one person who has now moved to Saudi Arabia. We'll be a hedge fund in Saudi Arabia. We can become a hedge fund, PMS, does not matter, because it is not a manpower-driven product. It's a tech, it's machine learning which makes all the decision, and that is the beauty of what we have built. And the next set of people who will come, they will explain how this whole automated decision-making and machine learning works. So we are going to be in India. We are going to expand more in Dubai. We'll be launching more funds there. We can become a fund, like I said, if we deploy these software on our accounts, where the money has been sourced from HNIs. If the money is sourced from retail investors, we'll be called mutual fund. Everything remains the same. We just have to go take the license, go raise the capital in tens of thousands of rupees and not 50 lakh rupees from retail. The computer doesn't care. It runs on an account. It makes decisions on data. It does not care where the money comes from. We take different shapes based on the regulatory landscape of the country. So the same thing that you see, a fund, an advisory is like a PMS in India, is what we do. So we can just keep going to any country and start running these products. We can choose which product to run, which product to not run, depending upon what kind of partnerships we can build in those countries. So if we work with institutions, we are a hedge fund. We work with asset managers, we are a hedge fund. We work with general public, we'll become a mutual fund. In terms of roadmap, this kind of tells you the roadmap. We have recently now we have started the office in India. There are 40 people who will work here. We have applied for an AIF category 3 hedge fund license. We have also applied for a PMS license, which means we can take your money and invest, as well as we cannot take your money and still invest for you in your account. The product is the same. The product remains the same. Eventually, the idea is to launch mutual fund, which will take probably 3 to 5 years. This is just one of the funds that we have launched in the long-term equity. We already have one long-short equity fund, whose architecture will also be shown. The idea also is on the structured products, we want to be the pioneers in India. There is absolutely no platform. We are developing a platform for structured product as well as for fixed income, because we anticipate a proliferation in the fixed income market. Well, for fixed income, you can think something like a Grow or something like what Zerodha is doing. Structured product, well, there is nobody. Okay, so structured product is something that I would be very keen on moving very fast in India. We have our biggest portfolio outside of India is in the structured product. So that's what the roadmap looks like. There is a licenses that we need to take. That's the licensing roadmap. In India, we are going to take a hedge fund license, PMS license, maybe a cryptocurrency related license. We are already applied for a cryptocurrency license in Dubai, UAE. Then there is a product roadmap. We will customize these products. Not very difficult, 80% we are already there, 20% customization for the Indian market. The most challenging part is solving the logistics, how the money flow moves and the instrument custody, etc., etc. We have kind of solved that as well. The tech roadmap, which is what the tech team will explain when they explain their piece. Right, thank you very much. I think that was what a brief overview of what the team has been doing for the last 12 to 15 months. And with that, I would now invite our Quant Long Term equity team to come and explain what have they been up to and what exactly is this Quant method of investments. Kaushik and team. One caveat, I mean, while these guys are all tech and engineers and coders, one thing that they are not, a smooth talking. I mean, none of these guys are the best orators that you will see on the planet. And that's why I would be standing by their side doing nothing, just to help them in case they slip. Kaushik? Thank you very much. Thank you very much.
Hello, 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 hello. Hello, 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 hello. Hello, hello.
जल्दी खा
Hello.
It's working.
Hello.
Start. Okay. So, hello everyone. Good afternoon. I am Kaushik Hati and I welcome you all to this presentation. About me, I have completed my Masters in Finance from IIT Madras and I have 5 years of working experience in this financial sector. Today here we are present. We wanted to introduce and speak to you about our division, that is Quant Long Term Equity Division, which is one of the 6 product division at 2Cents Capital. So these are our team members and they will individually introduce themselves as we go along. So here we present our first fund that we launched 2 months back for US market, that is 2Cents Quant Value Fund, and we are here to discuss about this and reveal this product. The objective of this fund is to provide long-term capital appreciation to all our investors. Now before I move on and discuss the process that we followed during the entire fund journey, I would like to mention that choosing quant as or the financial rationale behind choosing quant as our investment methodology. So basically if we look at, quant is an improvement over the traditional way of equity investing, be it fundamental analysis or technical analysis. Instead of that, quant focuses on systematic and rule-based approach, relying on mathematical models, statistical analysis and computational techniques for investment decision making purpose. Further, with the advancement of the technology like machine learning, use of AI in the area of finance, and also availability of huge volume of data, be it historical or be it real-time data, quant can process and analyze this vast amount of data set, and it can identify underlying patterns, trends, correlations, and it can exploit the market inefficiencies in a much better way to provide a data-driven decision-making process. So entire fund journey, whatever decision we are taking, there is no human involved. It is automated and data-driven. Now let's look at the process flow. The process that we have followed during the entire fund journey. We have followed a 3-step process in the entire fund journey. First, portfolio stock selection. Second, portfolio monitoring. And third, we have portfolio risk management. Generally in the industry, people put more effort on the stock selection part, and monitoring and risk management takes a back seat. When the market goes down, in the name of risk management, generally all us, like all the common people, we just do a average down our cost price. We do not even place a proper stop loss. However, we on the other hand, give equal importance to each of the 3 steps which we developed over the past 1.5 years, and the entire process is automated, and we will discuss about these 3 steps as we go along in the subsequent slides. Okay, so let's talk about the first step, that is portfolio stock selection. So this is the overall architecture of our portfolio stock selection that we have used for this particular fund, that is 2Cents Quant Value Fund. So we first start with deciding on an investable universe. So basically why it is important, because stock market has more than 5,000 stocks. Now which stock should we choose for our purpose of investment? Should we go with a large cap or mid cap or small cap, or should we invest in auto sector, infra sector or a tech sector, or even should we do growth or value? So this entire decision making process is automated using our index and sector rotation module. The purpose of this module is, when we ran this module for this particular fund, during the entire market cycle, and based on the market analysis, the result indicates value fund, if chosen correctly and risk manage for the next 3 years market cycle is going to outperform the growth funds. That is why we choose Morgan Stanley US Value Index as the underlying or theme of our fund, which has 500 stocks in it. This means, or through this purpose, we could narrow down all the 5,000 stocks problem to the 500 stocks. And this is where our entire model comes in place, and we take a input of all these stocks, and the next part of the stock selection process will be explained by Mayank.
So hello everyone, my name is Mayank Soni, I am from IIT Kharagpur. I'll be taking you through our stock selection process stepwise. Now this stock selection module is one of the most important module of our product division, and it is the engine of our whole division. Now once we have finalized the investable stock universe, we will move on to our proprietary multi-factor based quant model, which is the most crucial element of our stock selection process and is the backbone of our strategy. Now this model takes input of all the stocks in our universe along with 100 factors which quantify our investment thesis. Now these 100 factors were divided into 3 broad categories, being quantitative factor, which had a weightage of 70%, and then we have the macroeconomic factor and the alternative factors, which were equally weighted at 15%. Now let me take you through the details of each and every factor. First we have the quantitative factor. So quantitative factor is nothing but the set of all the fundamental and the technical factor that we use day to day in our market analysis. Now where fundamental factor are 60 in number and technical are 10. Now these fundamental factors were further categorized into 5 categories, being value, growth, momentum, quality, liquidity. Here are the various parameters that we used in order to quantify our approach in each and every category. Now this provided a very comprehensive market analysis, and then we have the technical factors. So these are the sample technical factors that we considered. Now moving on to the macroeconomic factor, here is a list of macroeconomic factors that we considered. Now macroeconomic factors are nothing but economic indicators that tells us about the market and its economics. They give a proper outlook of the overall demand, profitability and sector stability in the current market phases. Now then we have the alternative factor. Here is a list of factors that we considered for our approach. So why are these factors important? These factors provide early signals of market behavior, company performance and any potential risk that could affect the market, company and the sector we are in. So moving on. Now let us try to understand why this multi-factor approach is important. Now very simplistically, this provides a very comprehensive analysis, and another important benefit of this approach is that it helps in detecting financial manipulation. We have tuned our model in such a way that using cross-referencing analysis, we are able to detect whether a company has skewed its accounts or not. Now these factors are inputted into our quant model. So now an overview about the model. So our quant model is nothing but a mathematical coded automated model that leverages data from sources such as Bloomberg, Twitter and various news websites. Now we take the 500 stocks, and with the help of these data sources we calculate the 100 factors. We calculate the 100 factors over 20 quarters, over 80 quarters for the past 20 years, and then these data sources are stacked together and move into our machine learning model. So what essentially is machine learning? So machine learning is nothing but a model that can take huge amount of data set.
Hold the mic here, nothing is, आराम से रहो. Okay. आइसक्रीम खाते हैं ना, आइसक्रीम जहाँ रखते हो वहीं रखोगे.
So, machine learning model can take huge volume of data set, uncover any hidden trend and patterns in those data, and provide analytics for future predictions. Now let us try to understand machine learning in great detail. So in this example, we take example of two students and try to predict which one of them will be able to qualify the joint entrance examination. So here we have Ram and Sham, and the variables that we have taken in order to quantify this approach is number of hours a student studies, number of hours he plays, and number of hours he sleeps. So Ram studies for 12, while plays for 2 and studies for 7, while Sham studies for 3, plays for 6 and sleeps for 7. Now by simply analyzing this data, we can say that Ram has a higher probability of qualifying the examination than Sham, and our model predicted the same. Now this analysis was quite easy to judge because the number of students in this scenario were only 2. But what if it becomes 15 lakhs? That is the actual number of students appearing for the examination. Now it becomes more relatable. Why are we using this layer? Now let us convert this 15 lakhs into 500 stocks which have 100 factors each, which are calculated over 80 quarters. Now it gives a much clearer picture why we are using this approach. Now it is quite true that without using this machine learning layer, we could have made a similar analysis, but the results would not have been same. Now, if we would not have used the machine learning layer, we would not have been able to dynamically weigh each and every factor. For instance, we have around 100 factors in our approach. So if we have simply weighted them equally, that is 1% each, we would not have been able to capture the market dynamics properly, because at different phases of the market, different factors tend to dominate. Here are some other benefits, like it helps us with rebalancing, and it also enhances our predictive power. Now, one of the most significant benefit of the machine learning layer is its property of self-healing and continuous evolution. We tune our layer quite periodically with the upcoming of new data. And if it would have misclassified a data point in the previous set of training, then it weighs more importance to that data point in the next set of training. With the help of this, we are able to remove and reduce any bias or error in our calculations. So these are the various models that we have used, and I would love to talk about in great details over coffee or in the Q&A section. Now, with the end of machine learning, we have finished the first set of screening of our stock selection process. Now, here we have another additional, now we get the preliminary portfolio. Then we have another validation layer, which helps us in order to filter out some of the scrap stock that might have entered into our portfolio. So, we do this by measures such as the Petrotsky F score and the Altman Z score. In the interest of time, I will discuss this part later in the Q&A section. Now, with the end of the validation model, we get our final portfolio. Now, once we get our final portfolio, a simple question that must have crossed your mind is how much fund should we allocate to each and every stock present in our portfolio? So we do this by using something that is called portfolio optimization and allocation models. So these are the various models that we have used. Now, why it is important to perform this step is to find the optimal weights in order to get the best risk-adjusted returns. Now, then we evaluate our portfolio performance on various risk-return matrix such as Sharpe, Sortino, and Drawdown. Then we perform another set of optimization in order to reduce our risk exposure. With this, we get our optimized portfolio of 30 stocks. Then we pass on this set of 30 stock with optimal weights in the backtesting step, and finally after backtesting and another set of tuning, the funds are finally deployed in a live setting. So with this, we come to an end of our portfolio stock selection module, and then I will hand over the mic to Kaushik to discuss about the second step of this module.
Hello. So, we started with the first step, that is portfolio stock selection. This is the first step of the three-step process. Now, once the stock is selected, portfolio is created, and money is deployed in the market, we move on from step 1 to step 2, that is portfolio monitoring. We do portfolio monitoring in 2 steps. One is event-based monitoring, another one is business and stock-based monitoring. In event-based monitoring, we first look at various stock-specific events, like new launches of a product launch or a geography launch, mergers and acquisitions for a company, whether a company is hiring another business or company or it is getting hired, any change of management for a particular company, reporting of fraudulent transactions for a particular stocks or for a particular company, quarterly results announcement for a company, and different foreign institutional investments in a particular stock or in a company. So suppose these events might have a good effect in our portfolio if any of this parameter is being affected, and we take quickly actions based on the signals. We also have different macroeconomic events like interest rate decisions, oil price, election results, US labor market, industry performance or sector performance, and government policy or regulation. Macroeconomic events influence or impact the industry, sector, or even the broader market. So the purpose here is, if we can, since each industry is related to certain kind of macroeconomic events, if we can identify those leading events, analyze them, and forecast those variables, we will have the edge. That is where monitoring plays a very important and crucial role in this entire process. We also have different business and stock-based monitoring also. So basically, in this case, we look at the quality of the business of a firm or a company, the growth possibility of that business, the length of the growth period, and any disrupting event that can hamper the growth of that firm. And entire these things we do using our business analysis framework. For this, we have different business analysis framework like Potter's 5 forces, ANSOM matrix, BCG matrix, but in the interest of time, I'm not explaining this in detail, but if any one of you interested, we can do it over a coffee after the presentation. So, this comes to the end of the portfolio monitoring that we follow. Now, I will request Vaibhav to take care of the last and the final segment.
Hello everyone. So I'm Vaibhav Mehta. I have been working in finance for the past 2 years at firms like Motilal Oswal and Tata Capital. I also hold certifications in CFA and FRM. And I'll be taking you through our process of portfolio risk management. So moving on. Yeah, so when we talk about risk, every portfolio and every asset class has some sort of risk associated with it, right? So what we try to do is we try to mitigate those risks using our hedging strategies and quantitative models. Now that was a lot of terms, right? So I would like to explain to you using a rudimentary example here. So let's say our portfolio manager, his job is like equivalent to a job of a tightrope walker. He's walking, this is our portfolio manager. He's walking on a rope of volatility. Volatility here represents the uncertainty in the market, and he's always at a risk of falling down. So basically what our hedging strategies do is, it's like a safety net for the portfolio manager. So 20%, the difference between the volatility, the rope and the safety net, that is 20%. So that's where all the action is happening. All the asset returns and calculated risks that we are taking, that happens in that 20%. And the net represents 80%. So basically it means if your portfolio is 100 CR, your money is not going below 80 CR. So 80% of your portfolio will be hedged at all costs. No matter what happens in the market, it will be there. Moving on. Now I'll be talking about the risk management architecture at our firm. So we start with the equity portfolio that Mayank was talking about, and after that we sit and select different risk management tools, and we use those tools to create different hedging strategies, and some of them are proprietary that I'll be talking about in a while. And then we do the implementation part and revision part. So basically we renew our strategies and different tools that we are taking in every 3 months or so. And yeah, that's what it is. And moving on, the risk management instruments that we are using is basically just futures, equity index futures, options, different kind of combinations of options. And then Quant Hedge signals. So Quant Hedge is our proprietary model that I'll be explaining to you in the next slide itself. So we use signals generated from that model. Moving on. So Quant Hedge model is our proprietary model that we are using. It's a market signal model. It generates a signal from +1 to -1, and explaining you the sub-models in it. So it has 4 sub-models: macro, bottom-up, behavior, and valuation. So these are the factors that we are evaluating. So in macro, we can see inflation and credit cycle is there. In bottom, it has quality, early momentum. And in behavior, it is basically the sentiment in the market, what is happening in the market at the moment. And after that, we have valuation, dividend yields that we are taking, and earnings yield, interest rate in the market. So these are the factors that we are using to make this model. And after that, right now it is covering US, Europe, and India equity markets, and the signal, so the signals that are being generated from +1 to -1. So +1 basically represents going long on the market. Then market is in a bull run, and then that's what +1 it is. And -1 is basically going short on the market. So our strategies, kind of adapt according to the market signal that are being generated through the Quant Hedge model. So yeah, and these are the hedging strategies now. So we have divided this into 2 buckets. One is the traditional strategies, and the second one is the Quant Hedge proprietary strategies that we have worked on for the past 9 months, and we have developed it and we have used it, and it's working. And I'll be explaining to you. You can refer to the brochure as well. It is mentioned there. So as you can see, the traditional strategies are the one that everybody knows, every other firms use. So they're using it, and yeah, these, I'll be explaining you the results as well. We have practiced all of them, and these are our proprietary strategies. And if you want to know more about it, you can always hit me up, and I'll be very happy to answer to you. So now talking about the performance, everybody cares about performance, right? What did we actually do? So, So starting with the returns that were generated through the equity portfolio that we created from the Mayank's and Kaushik's part. So the returns that were generated was 19.3%, and volatility was 16.7%. So volatility here is basically the risk that we are taking. So it's 16.7%, and Sharpe ratio basically represents the amount of risk that we are taking for the amount of returns that we are generating. So it is supposed to be more than 1. It means that the returns that are being generated are, if it is 1, it means that the returns that are being generated are equal to the proportional to the risk that we are taking. So that's what a Sharpe ratio it is, and 1.08 is the value for the equity portfolio, which is decent. And if we talk about the drawdown, it has gone down to -40% at times. Now that's where my job comes in. So what I have to do is I have to reduce that drawdown. We have to increase the Sharpe ratio, because we want to take lesser risk and create more returns. So talking about the traditional strategies. So whenever people use traditional strategies, the volatility, the risk that we are taking obviously goes down, but it comes at a cost. The returns, as you can see, 19.3%, it has gone down to 18.8%, 0.5% returns have gone down. So, and the Sharpe ratio has gone up, drawdown has gone down, that's all fine, but we are losing money here. So now, what we do at 2Cents Capital is we have created our 3 different strategies that we are using at the moment. And as you can see in the first strategy, the returns are exactly the same. You can see the volatility, 16.7%, and here it is 13.7%. The risk has gone down by 3%, but the returns are still the same. It is 19.3%, which is phenomenal, right? But we have even better strategies here. We are actually making money through hedging here. So we are taking lesser risk, and we were able to make money through that. 0.5% extra. we were using the quant signals, and you know, if you want to know more about the strategies that we are using, you can always connect with me. And so this is basically what we did in the hedging part, making money through hedging, not actually taking it as a cost. So, and the Sharpe ratio and everything, drawdown has gone down from -40 to -23. So yeah, this was our hedging part, or the risk management part at our firm. And thank you very much, everyone. Now Kaushik will be concluding for the last part.
So yeah, so this was all the presentation about the product and the fund. So now we have come to the conclusion. So I would like to mention that we have started our journey 2 months back by launching our first fund for the US market, that is 2Cents Quant Value Fund. For this particular fund, we have took as an sector agnostic approach, because since we are a startup and we are launching our first fund, we thought a sector agnostic approach, the benefit is we were out of the sector specific risk and we are only exposed to the market risk or the systematic risk. And for that purpose, we have developed, as Vaibhav was mentioning, different specific risk management strategies. But each sector, when we studying, has a lot of potential, and each sector actually deserves sole attention, and we will do that in our future roadmap purpose. So, and this is our broader allocation strategy. We give 93% of total AUM for portfolio allocation, 3% of the money we are using for hedging purpose, and 4% we sit in cash to meet any market or any exigency requirement if we have. So this is, now let me take this opportunity and present our future roadmap. So this Quant Long Term Equity division is focusing on, in the Q2 of 2025, 2Cents Quant Value Fund for the Indian market. Since the entire process is automated, so what we can do, or what we are planning to do, we have taken for this purpose Morgan Stanley US Value Index. If we replace this with Morgan Stanley India Value Index, we will be able to launch our India Value Fund, and we will do some back testing, we will do some optimization, factor adjustment, and that's why we are planning to launch it in Q2 of 2025. Then in Q4 of 2025, we are planning to launch one long short equity fund. And this is the overall architecture. Currently, this is in the testing phase of our lab. We need to do some more refining this strategy and do some back testing, and then we will be able to. So that is why we are planning to launch it on Q4 of 2025. Apart from that, 2026 is also going to be very full, because we are planning to launch one mid-cap quant fund, one small-cap quant fund, and as well as one sector-specific quant fund as well. Because by that time, we believe we will develop more knowledge about each sector in the market. Okay, so finally, our purpose is, we are going to refining all the existing strategies. We are going to develop new strategies for stock selection, for monitoring, or for risk management part also. Along with team building will go on, entire process and the system will also elevate. Now, if you ask, what is the plan for immediate plan for the next 9 months? For the next 9 months, we are planning to monitor this particular fund. I am telling you, this fund, that 2Cents Quant Value Fund, has an immense potential. And if we manage it properly, it can give up success, we can make it more successful, and we are trying to build up fund CB, because the philosophy we follow in our team or in our division, that there will be no compromise with that quality, no cutting corner. Also, we are evolving as a team, and we are keep working hard, and we are improving each day, not only for ourselves or for the investors, for the organization, but what we are doing only for our investors, because protecting investors' interest is our key to success, and we are promised to. Thank you so much. Thank you for your patience, attention. Thank you. Now I will hand over to sir.
Thank you, Kaushik and team. That was quite interesting, particularly how quant works. That what I'm sure a lot of people must have found this to be interesting. So yeah, you guys can go back. I don't know if you guys are being served tea, coffee or not. I mean, this is a pretty good time to make yourself comfortable with a tea, coffee break. The next on the agenda is the cryptocurrency team. Well, the thing about cryptocurrency is, for some reason inexplicable, India has not been playing ball with this whole domain. And the world outside of India has been galloping in this universe. Trump himself has launched a Trump coin after he became a president. Melania followed suit and launched her own coin, causing a 50% drop. The latest brush of evolution that we have seen in the Indian cryptocurrency landscape is the launch of the Geo coin, which tells you a few things. In the next at least 4 years, cryptocurrency is not going anywhere. And India will be arm twisted to adopt cryptocurrency, if not now, in a few years from today, because the entire world will do that. US today is now trying to set up a Bitcoin-based fund. Now, if they're going institutional with this, I mean, it is anybody's game to understand if this is in any kind of danger. All right. So, moving on, like the cryptocurrency is one of the divisions that we have. We have a significant investment from the investors in the cryptocurrency asset class as well. I think this asset class makes tremendous amount of sense to deserve an allocation in anybody's portfolio. The numbers could differ. You can move from 5% to 10%, whatever your risk appetite is. There are a few things. Okay, so this is the team that has been handling the entire cryptocurrency sector for us. Nitesh, who's also the head of technology and products, is a cryptocurrency guy. He's a computer science engineer. Satyam, a guy from IT Madras, has been doing cryptocurrency for the last 2-3 years. Anthony Kings and Jayavardhan, IT Delhi. So they will introduce themselves as we go along. There is no denying the fact that the blockchain technology in general and cryptocurrency in particular is going to be the future of a lot of things in times to come, and finance is no different. The question is, as people in India, are we going to be a part of it, or are we going to miss the bus? Like the way I explained about structured product, I said the structured product is a $2 trillion, 170 lakh crore asset class across the globe, kind of non-existent in India. Cryptocurrency is 3 trillion, 240 lakh crore asset class outside of India. In India, it is still brushing some bit of, I don't know, it's not still catching the kind of momentum that it should be doing. There are reasons for it. Okay. So like you see, BlackRock has now adopted. Now this is essentially one of the largest funds in any form on the globe. El Salvador has a crypto fund, and it has kind of said that is its reserve currency. Reliance Jio has now come out in the cryptocurrency world. The problems in India, the reason why in India we have not been able to see an uptick in the cryptocurrency adoption and a positive vibe is because of regulatory bottlenecks. You have limited accessibility. Most importantly, there have been frauds, number of them in the cryptocurrency. People have been duped of, crores of rupees because of fraudulent activities. It's very volatile. The volatility is coming down, but yeah, it continues to remain very volatile, and this has not been the go-to asset class for people who do not like volatility. And the tax complexity, which means you have a mark-to-market on which you have to pay tax, but if the currency actually falls when you sell, then you do not get a set-off on the tax. So you lose the money that you have paid, your tax, in terms of mark-to-market as valuation. Okay, I woke up to today's morning and this was the news article that was there, and I said, yeah, of course. Now, a lot of people would be looking at this and saying, okay, cryptocurrency is for thieves, we can't, this is blanket statement, cryptocurrency nahi karna hai. Ye chor hai. Now this is one sparrow, does not define the entire summer. So this was an aberration globally. I mean, this will continue to happen. It has been a go-to technology for a lot of fraudsters, for hackers, so on and so forth. But that does not take away, that adoption will change everything. That does not take away the fact that cryptocurrency as an asset class and blockchain as a technology is a brilliant consideration, and one must consider taking a look at it in a serious manner. Okay, so we have built a lot of competence in the cryptocurrency department, and we have also addressed most of the challenges that you saw in the previous slide has been kind of addressed by us in the last 12 months. And I will now invite the team to speak about how they have been working on the cryptocurrency fund creation, where is the focus, what do they think is going to be the value creator for anybody who wants to enter, who looks at this as an investor, and how have they addressed the cases around fraud, the cases around regulatory challenges, so on and so forth. With that, let me invite the team. These are the four broad, cryptocurrency is a large universe. We focus on these four categories. And Jay, would you like to start? So I would request Jay to get started on the first category, which is a venture.
Thank you, sir.
This goes forward, this goes back.
Hello, everyone. My name is Javardhan Maiwal, and I'm from IT Delhi. I have 3 years of experience in blockchain industry. Today, I'll walk you through the evolving crypto startup landscape. Let's take a journey and go 3 decades back to the era of dot-com boom, where the internet is the new talk of the town. Big investment firms are expanding their portfolios to invest in emerging web giants. Small firms are leading the early adoption, and equity market is about to see exponential gains. Google and Amazon have generated enormous amounts of capital throughout this internet revolution. Now, fast forward to the present day, we've been hearing about this new crypto boom. Crypto is the new talk of the town. Big investment firms are adding cryptocurrencies to their portfolios. Small firms are leading the early adoption of cryptocurrencies, and crypto market is about to see exponential gains. Looks good, right? Remember Google and Amazon? Consider these numbers. Ethereum's 2015 ICO has generated 600,000% of returns for its investors. Solana's 2020 ICO has generated 10,000% of returns. Sorry for the wait. Solana's 2020 ICO has generated 10,000% of returns for its early investors. We have entered 2025 and crypto is still in its nascent stage. Looks exciting, isn't it? How does it all work actually? I'll explain. It's very simple. ICO, that is an initial coin offering, works like an IPO, where you identify the asset, you invest in it, you monitor the growth, and you enjoy the returns. It's very simple. Now let's take a look at what's very exciting in the ICO. Considering the IPOs offer annualized returns of 30 to 50% in 10 to 20 years, whereas ICOs offer annualized return of 50 to 70% in just 3 to 5 years. But it's not easy as it looks, right? In the crypto universe, it's very risky. So these extra returns do come with extra risks. Let's have a look at them. Risks in ICO can be categorized into 4 main areas. First, misinformation. That is the disconnect between the investor's expectations and team's perspective. Second, capital misallocation done by the team due to their incompetence. Third is systematic risks, or should I call general market risks. And the last is weak legal protections, for which crypto is heavily criticized for. Every day, almost 1,500 cryptocurrencies enter the market. It's almost impossible for an individual investor to research and invest wisely in all these crypto projects. Due to this, most people try to hold their blue chip coins and index coins, and they have to leave their hopes to invest in an ICO and capitalize on massive returns of ICOs. But don't worry, we have the solution. For the past few months, we have designed an architecture to help you overcome this behemoth of a challenge. Our architecture comprises of two different structures, tackling two different kinds of challenges. First, we look at the fundamental parameters, checking the team's dedication and the innovation they bring to the table. Second, we look at the legalities through our robust legal structure to mitigate the risks involved in crypto. Check out our brochure to find more details and nuances of our architecture. Through this, 2Cents Capital will help you overcome legal problems within crypto space through our robust legal structure, identify good projects through ingenious screening model. Now, you can confidently invest in promising ICOs and capitalize and maximize your returns. Thank you for your time. Over to Anthony. Go to the right.
Thank you, Jay. Hello, everyone. Good afternoon. I am Anthony Kings. I have a bachelor's in computer science from VIT Vellore, and I have 3 years of experience in cryptocurrency markets. Today, let me introduce you the 2Cents Capital Crypto DeFi Fund. So first, what is DeFi? DeFi stands for Decentralized Finance. It is a new financial technology. Using DeFi, you can perform lending and borrowing, trading, and also payments, and also insurance. Now, let's go back in time, the time before DeFi. So before DeFi, if you want to get consistent returns with minimal risk, you choose fixed income products. But fixed income products like FDs, government bonds, and corporate bonds gives you a return of only 5 to 7%. Is this sufficient? The answer is no. When we account for inflation and other miscellaneous stuff like fees, taxes, there are some cases where you actually lose money. And this is where DeFi comes into play. Under DeFi, we offer 3 products, starting at our liquidity provision, staking yield, and our stablecoin yield. Now let me quickly compare fixed income with our DeFi fund. Our DeFi fund offers almost double the return compared to a fixed income, and also there is no lock-in period. And the most important thing is it not only outpaces inflation, but also you can grow your portfolio through DeFi. Sorry, with this I usually stop my presentation, but some of my clients actually have this question. Anthony, isn't crypto more risky? And this is where 2Cents Capital comes into play. Where others sees risk, we see strategy. We follow a 3-step framework of network allocation, followed by protocol allocation, and the third and final step is cryptocurrency allocation, which gives us our complete DeFi portfolio. In the world of cryptocurrencies, we have 100 networks, 500 protocols, and 1,000 cryptocurrencies. Are all these are good investments? The answer is no. That's why we have created this black box. This black box filters through and gives us the best top 10 networks, 22 protocols, and 15 cryptocurrencies. Now, you might have this question, what this black box is made up of? This black box is a multi-factor model with more than 150 plus factors, which gives you the best portfolio. Now, let me quickly compare a portfolio created by a team at 2Cents versus an average retail investor. A portfolio constructed by a team at 2Cents gives you a well-diversified portfolio, gives better returns, and has the best risk management. With that, I will pass it on to Satyam. Thank you.
Thank you, Anthony. Good afternoon, everyone. My name is Satyam. Today I will explain the crypto long-term fund. Okay. So you all already know about stocks, right? The stocks created a very good growth for past years. And if you invested $100,000 in 1980, it would have become, in SP 500, it would have become $5 million today. Now innovation accelerates. The next $5 million opportunity is not in stocks anymore. It's in crypto, the new wealth layer. Now if you invested $100,000 in 2014 itself in Bitcoin, it would have become $5 million by now. It nearly 5 times more faster growth compared to S&P. Now exponential returns also comes with exceptional tech. So Amazon, it's a big giant company. Amazon grew around 13x in 10 years, whereas Bitcoin grew around 200x compared to Amazon in the same time. So today investing in crypto is just like buying Amazon stocks pre-IPO. So it comes with massive returns, but also crypto have a lot of challenges like identifying good coins, same as identifying good stocks. It's very hard. It's same in crypto too. It's more volatile than traditional market, and frauds and hacks literally happen every day, every time. And next is it's very complex technology. It's not easy to understand, and a lot of techie people also face a lot of difficulty in understanding that. So we have simplified the process and give you a crypto long-term fund, where we follow clear automated quantitative process with deep research and real-time adaptation and through rigorous risk management. This is the investment framework we follow. So first, the crypto universe, we take the crypto universe, screens it, allocate it, and monitor it with good risk management. A simple process, but a lot of goes under the hood. Using this investment framework, we created a platform which takes around 2,000 plus coins, and a quant filtration model goes through 100 plus factors and gives us 20 coins, which is investable. Now, using these 20 coins, we create 3 long-term portfolio. So first is BTC ETH portfolio, which is similar to blue chip traditional market portfolio. And next is altcoin portfolio, which is similar to mid cap, and Degen portfolio, which is similar to small cap in traditional market. That's how we create the long-term fund. But this technology is very new, and a lot of things is going on. Recently, Trump also launched his own coin, Trump coin, and Geo launched his own coin, GeoCoin. And I believe in 4 years, we will be adapting it very fastly, and it will be there everywhere. So if you're interested to get in the call with us, scan it, and if you're ready, call us or miss the bus.
Okay. All right, thank you very much, Satyam and the crypto team. What we'll take now is we'll take a quick 5-minute break, just like a bio break or washroom, whatever. And then after we assemble again after a small break, we will talk about our crown jewel product called the structured product, which, like I said, will be presented by a team who decided for some reason to enact. So let's see what they have put together to explain what is structured product. So we'll take a quick 5-minute break and then we'll come back again. Thank you very much. We call it the crown jewel team. The structured product team, they have decided to do it in a fun way. The last presentation is of the tech platform that we are building. I do not understand what they do. I guess somebody from the audience probably would. So that is going to be a heavy presentation. There is no way we could dumb it down any more than what I saw on the PPT. So the first order of business now is a structured product presentation by the team. We'll get started in 30 seconds. पास रहना चाहिए, मुंडी अगर हिलाओगे तो वो भी हिलना चाहिए, ठीक है, वरना ये हिल जाता है। और ये दिस इज ग्रीन टू गो फॉरवर्ड, रेड टू गो बैक, क्लियर? ओके, निश्लेष को भी बोल दो, इसको भी बुला दे, निश्लेष को भी बुला दे, शौर्य इधर आप।
माइक नहीं सर, वहाँ जो रखा हुआ है माइक को। इसका होने देखे इसके बाद
किसका होने दे?
फोटोशूट चला
नहीं, गेट स्टार्टेड
करो स्टार्ट।
वो मामा आपका सीटीओ है, जैन चौहान डिग्री का लड़का है मामा आपका।
So, good afternoon everyone. Today we are going to present you a very new asset class which we are calling as structured products. You may not have heard about this before, but give us half an hour and we will make sure that you would want this in your portfolio. So please be seated and let's begin. This new asset class, which we are calling as structured products, is basically a simple combination of two or more traditional asset classes like bonds, stocks, and options all combined together to make this magical product what we call structured products. These products are so much customizable that they can be customized to cater any needs of an investor. Now let me take you through a short example. Imagine you are investing in Nifty 50, which is same as S&P 500 in USA. If your market would go up, you would get positive returns. But then, if the market would go down, you would lose some of your returns. Now, imagine investing in a structured product based on S&P 500. Now, the scenario would change a little bit. When the market would go up, you would face no losses on the downside. And when the market would go down, you would be protected. So this was the magic of structured products. In fact, we can have such scenarios in which when the market would go down, you would have no downside, while the other investors who didn't invest in the structured products would be facing losses. Isn't this product amazing? Yes, it is. But it looks little complicated. Why we need to combine stocks, bond, and options? So let me make it clearer. Suppose you invest in a bond of Tesla, then irrespective of how the stock performs, you will always get an interest of 6% after a year. So here, our y-axis is showing profit and loss, and x-axis is showing stock price. This indicates current market price of Tesla. Now, if we directly invest in stock of Tesla at this current market price, we will be profiting when the stock climbs. And if the stock falls, we will incur some losses. But what if I say a structured product can offer you returns of 15 to 20% with all your invested capital being completely safe in any situation? So you might be thinking, अगर ये इतना ही अच्छा है तो आपने इसके बारे में सुना क्यों नहीं? Structured product इंडिया के लिए नया है. Globally, structured product market size is around $2 trillion. That is 170 lakh crore rupees, which is 60% of India's GDP. Now, अब आपको लग रहा होगा ये इंडिया में बिक क्यों नहीं रहा है? The reason is regulations. India allowed only $25,000 of capital convertibility. That means if you are Indian investor, you were only allowed to convert your INR
to other currencies worth only $25,000 a year. But now, with new regulations, this limit has been increased to $100,000. That is, now the structured product market has become feasible for Indian investors. And it is not ready-made, it is OTC traded. We need to design it, customize it. Then we need to approach a bank and get it made. Because it is very much customizable. It requires a lot of mathematics behind it, which makes it little bit complicated. And that's the reason why most of financial advisors advise to invest in stocks and mutual funds. So these are the reasons why structured product is not very well known in India. Now, every investor has a unique risk preference, which typically falls into one of these three risk buckets that are, first bucket is for low risk investors, second bucket is for medium risk investors, third bucket is for high risk investors. So the structured products that comes under first bucket are termed as principal protected notes. This can be compared to your fixed deposits, but it guarantees you at least 30% improved returns as compared to fixed deposit returns. Now, let's move to our second bucket. The structured product under these buckets are called enhanced return products. We can compare these structured products to mutual funds, but this is a better alternative. Now, for risk-loving investors, we have accelerated return products. This can be compared to futures and options trading. A report by SEBI shows that 89% of retail futures and option traders are losing their money. So let me give you a quick example of a structured product on Reliance. So the y-axis indicates your profit, and on the x-axis is our stock price. The current price of Reliance is at 1300. And the green line indicates what happens when you directly invest in a stock. And blue line indicates when we invest in a structured product. Now, if Reliance increases by 10%, this structured product can offer you a return of 8%. You will think, why to sacrifice this 2%? The reason is, when the stock declines even by 80%, your capital will still remain protected. You will not face any losses. Now, let me show you a magical product. This product is to 50%. You will be able to get returns of 50%. But if Tesla increases by more than 50%, your returns, that is, if Tesla increases by 60%, then also you will get 50% return. But now comes the magic. When every investor will be facing losses, when the Tesla price declines, you will still be benefiting from structured products. If the Tesla price declines by 20%, you will be getting a return of 20%. If it further declines, then also your invested capital will remain protected. And all other investors will not be able to sleep peacefully. So isn't it nice? Now let's see how it is made. So for making this product, we take up your capital and split it into some parts. We invest a major part of your portfolio into bonds. And then we buy a special type of put option. And we buy a call option. Also, we sell a call option of different strike. I know it may sound very boring and all this is very complicated, but you don't need to worry about it. You can sleep peacefully and all this complexity will be handled by our team.
Alternative of directly investing in the stocks. So for example, you are investing in Tesla. When Tesla goes up by 10%, you will be making the profit of 10%. When it goes down by 10%, you will be losing 10%. But what if I say Tesla just goes up by 10%, but you can get 15%? Further, I'm also providing you the safety net of 10%. That means when Tesla goes down up to 10%, you won't be losing any single penny. You will only lose when Tesla goes down by more than 10%. I know, nobody wanna lose their money. So you may be thinking, can I increase the safety net? Of course, at 2Cents Capital, we have the solution for every problem. I can increase the safety net to 15% or even more. But there is a trade-off. Here, instead of getting 15%, you may got just 12% or 13% when Tesla rises by 10%. You may be thinking how this product is made. So let's take your $100,000, divide it in 3 parts. First part will be used to directly invest in the equities. The second part will be used to buy a call option. And the third part will be used to buy a special type of put option. But don't worry, we will take care of it. And this is how your final customized product look like. I know, many of you are still worried कि 15% से नीचे stock गिर गया तो क्या? Will I be getting losses? No, we are here. We have developed a lot of mathematical tools and hedging techniques. So these hedging techniques will be acting as the safety net for your investment trees. And this investment tree will be protected from the storms and the market crisis. You just need to relax, chill, enjoy the benefits of your investment tree, and we will take care of everything.
Yeah, I thought so. My coming on the stage was the welcoming clap I received. Nothing to do with the presentation they made. Okay, so this is what I was telling about. So this is the product which I've been working on for a long period of time, and these guys came along, they have automated it. They have done it on a lot of US stocks today. But where we stand now, we can just remove the Tesla from the bottom. We will put Tata Motors and we can launch it in India. And this is true for most of our products that we have built. The long-term equity quant that we demonstrated, the whole architecture has been built, the platform is ready, and all you have to do is remove the Morgan Stanley 500 value index from the top and put a nifty value index. You do some bit of customizations, and right there is your India fund ready to be launched. The only thing that is stopping us from doing that is the license, which we'll get in probably 3 weeks. Like I said, and I would repeat, we do the same thing because it's a tech solution. Instead of doing it in our account, we'll do it in each individual's account. We will be called a PMS. And that's another license we get. The tech remains the same. Everything remains the same. It's a totally different business model. The third business model would be, we do it in an account where the money is coming from retail investors. Now we are called a mutual fund, not a hedge fund. So the same product, different licensing arrangement will make us 3 different creatures. Coming back to structured product, like Nishlesh was mentioning, this is a $2 trillion investment asset class. Unfortunately, not very prevalent in India, and the reason being, like I had mentioned earlier, capital convertibility norms have just been relaxed 5 years back. So it's a very nascent in terms of Indian context. You will not find anybody doing structured product. There is a smaller variation of structured product called MLDs, market linked debentures, which is 1% of what the entirety of structured product is. There is 1 or 2 organizations I know who does this, but they only do it for family offices. So I'm pretty sure most of you guys will not have these structured products in your portfolio, and that is true for most of the Indian investors. This can be corrected. That is first point. The second point is the structured product is pretty safe. There are ways of making it safe. The only time they become risky is when you stop paying attention to the risk management or the risk limits of these structured products. Because like you saw, they are a combination of 2 or 3 different type of instruments put together to create the payoff diagram that you want as an investment philosophy. So with respect to structured product, this is the biggest instrument that we have in our portfolio outside of India. And we would coming into India and launching this, this for US securities. So if there are investors in India who want to invest in structured product outside of India, which is dollar denominated, we can help these guys, we can help those investors do that. The second problem, apart from the regulation, is this is not an exchange traded instrument, which means the way you buy your shares, you cannot buy structured product. You need to solve problems such as who will be your custodian, who will be your settlement, who will be, I mean, there are a bunch of stuff that happens when you do a transaction. You don't see them when you do a share transaction, but you will have to take care of all of that when you do an OTC, over-the-counter, non-exchange transactions. We have solved this problem in the last 18 months, and we have already tied up with a bunch of issuers, custodians, service providers, merchant bankers, so on and so forth, and we have an existing tie-up now with almost everybody who does structured products across the globe. So we can make all of that available to any investor who wishes to consider structured product as an investment opportunity. The second problem was complex. It is complex because it requires a lot of funky instruments to be built in. The way to handle that is nothing but brute force. You put good people who have good understanding of mathematics, who have good understanding of finance, and people who can code. You bring them together, you give them a year's time, and you will get this. This is what the product which is already in existence, built by the team. On the left-hand side, what you see is a pricing tool. All we need to do is keep changing the underlying from a Tesla, Nvidia. You keep changing what do you want. You want 15% protection or a 10% risk, or I want this, I want that. They will keep changing these parameters here. They will keep changing the issuers. Those are the different kind of structured products. I have no understanding what this is, but I'm guessing this is the code which defines those products. Okay. So that whole complexity has been solved over the last 12 months, and we are pretty confident of where we are. Right now, we have solved the problems around US dollar denominated structured products, and we are currently working, and the biggest problem is license. The tech is ready, the maths is ready, the finance is ready, the license is not. And we would be applying for the licenses pretty soon. Once we get that, we are in a, and we have already had discussions with some banks. We have a few banks on our radar who we have been talking to, and we have been demoing our tools and the entire tech to them. They have liked it. They said the day with our license, they will help us launch rupee-denominated structured products in India. Yeah, so this is what that is. The day we can do that, we'll be very happy. So, as far as structured product is concerned, I mean, the vision is to become a one-stop solution where you want to invest outside of India or India. The name that you should call is 2Cents Capital. I think we have the skills, we have the people, and we have the understanding to solve this problem end to end. Thank you very much. That was structured products for you. Thanks a lot.
Next.
Okay. Okay, the team wants me to show this slide. Okay. So they have prepared a report. The QR code will probably give you a sample of the report that these guys prepare with their automated software tools that they have built. Thank you very much, guys. Thanks a lot. Okay, so I thought that was a bit fun and a bit relaxed in terms of the instrument. Now the last part is a part which is the tech. BlackRock has Aladdin. We are trying to build something like that. And this is a team of 6, 7 computer science engineers, I told you. 2 of them, one is a 9.8 pointer from IIT Delhi, Arpit. Stop doing all of that and now come here. You are... Good, good, come. Come. Who's handling the PPT? Raghav joining? Where is Okay, so 2 of the people are still, they're finishing their master's project. They'll be joining online. And this is the team. Where is the ringmaster? Okay, so this is the platform that we are trying to build. We call it the Synapse because this is what connects, this platform connects everything to everything. Like ultimately all the data resides here, all the tests are done here, and all kinds of funky stuff. I mean, your machine learning models reside here, your artificial intelligence models for each product, and you have different ML models for different products. And this will be presented to you by Nitesh.
Thank you, Priyesh. Hello guys, so this is our last presentation today. We are at the climax now. So I'm warning you, get a cup of coffee because it is going to get a bit technical. What you have seen so far is all the shiny parts of the car, the mirror, the seats, the cushion. What you're going to see now is the driving force behind the car, the engine. So as I've already said, engine has oil, it has grease, and it's a bit technically complicated. So please bear with me for the next 30 minutes. I'll make sure it'll be worthwhile. So just fasten your seatbelts. We'll just start riding it shortly. There is a bit of, my teammates are joining online, so just give us 5 minutes and we'll be starting the presentation shortly.
Will you be getting some kind of display? Will we be getting some kind of display here? The slides. I hope we will.
Yes, sir.
So, roughly a year back, when we started building 2Cents Capital, we set out to build 5 high-tech quant-driven verticals: structured products, fixed income, quant trading, cryptofolio, long-term equities. Everything is quant-based. We wanted it automated end-to-end. So initially during our early days, we were looking for a one-stop solution that could cater to all our infrastructure needs. We wanted right from data fetching to integrating the data on various layers to performing various kinds of different computations and generating multiple tier sheets. We want them end-to-end covered all under one product. But honestly, the tools that were available in the market were not just insufficient, but they were kind of holding us back. So we had to do what we do best. We built it ourselves. So we are engineers. So that's Synapse for you. So Synapse is the powerhouse of 2Cents Capital. It connects through all the different layers of all the different layers, right from fetching data to performing various computations with our ML models and generating multiple levels of tier sheets. This is done for all our 6 products, all under one hood, with a modular architecture and a scalable infrastructure. So all of you guys here, so it's he doesn't need partners. So he wanted the best bloody platform on the planet. So to do that, I had to have a best team with me. So 6 months back, we scouted across India, and we assembled together a team of full stack developers and quant developers to make this platform possible. And that is how we are here today. And today, me and my team would be presenting Synapse to you. Good afternoon, everyone. So this is Nitish Kumar. I'm head of product at 2Cents Capital. So this is the product architecture of Synapse. So at the right, you see all the different verticals that we have at 2Cents. So it starts with structured product. We have our quant. Yeah. Okay. So what you have here on the side is all the different products at 2Cents, right from structured products, fixed income, portfolio equities. Everything is quant-based. It needs to be automated end-to-end already. So we came up with 7 different types of layers. So before we dive into each of these layers one by one, let me just spend some time about what Synapse really is. Okay. So let's say you write a piece of code. Okay. Now let's say you need to perform return an alpha. Now you need to perform backtesting for that alpha. All you need to do is the same piece of code, give it to backend, and that will roll out. Levels of backtesting. You take the same piece of code and take some other functionality. Instead of backtesting, let's say you pick multi-asset backtesting or multi-time frame backing. The same piece of code, just these functions down, and you select either a single asset or assets or multiple assets or multiple. Just repeat this so you guys understand clearly. At the left side, you have the alpha that you generate, and at the center, you have all different kinds of computation on Synapse, right? Back hyperparameter tuning, walk-forward optimization, Monte Carlo simulation, CPC, stress testing, and scenario analysis, and a lot more. So all these different kinds of computations that I listed right now, you can perform them either on single asset or multiple assets or multiple asset classes on single time frames or multiple time frames. So that's Synapse in a nutshell, and we'll be diving through the complete architecture in the next few slides. So these are the 6 major layers in which Synapse is built on. It starts with the data layer. Data layer is where all of our data is accumulated, and it goes to the strategy layer where the real building of alpha happens, and then the processing and computational layer, which I explained right now with different sets of computational techniques we perform. Then the simulation layer, which is used to simulate the alpha on both forward testing environment as well as real trading environment. Then finally the tier sheet generation layer, which throws out 3 levels of multi-level. And finally, to bring it all on cloud, we have the distributed computing layer. So one major problem that quant traders face right now is most of the quant researchers spend most of their time on building infrastructure. So what Synapse really solves is all the quant researchers who are working at 2Cents Capital, they just work on their core alpha. So they need not rewrite their codes to perform various activities. The complete definition of done that we have for our quant trading divisions, everything is covered end-to-end on Synapse. So all they do is they just come up with that one file, and they start with the top of the funnel, and they're able to get the complete tier sheets out. So now my colleague here, Praneeth, he's joining actually online. So he'll be walking you guys through the different properties on the data layer. So over to you, Praneeth, now.
Good afternoon, everyone. I'm Praneeth. I'm a graduate in electrical engineering from IIT BHU Varanasi, and I'm currently working as a quantitative developer at 2Cents Capital. I work closely with the Synapse team, and now I'll be explaining about the properties of data layer. So to begin with, there's the number of markets that are being covered. So 5+ financial markets are covered through the data layer. To name them, there's the Indian markets, the US markets, crypto, commodities, forex, and a few more. Then comes the number of global exchanges that are being integrated into the Synapse platform through the data layer. So over 100 different global exchanges are integrated through the data layer. And along with this, over 100,000 different symbols and parameters belonging to numerous financial instruments are being tracked simultaneously through the data layer. The data layer also boasts a strong 20 long years of historical data, which is efficiently stored within the Synapse platform. Along with historical data, live data streams are also integrated periodically from time to time into the Synapse platform. And in order to give you an idea up to the precision to which data is present within the Synapse platform, it is present across 7 different time frames, which include tick level data, 1 minute, 5 minute, 15 minute, half an hour, 1 hour, 4 hour, and a day up to durations of data. And as I've already mentioned, the data layer holds humongous amounts of vast data, which amount to over 5 terabytes of compressed data and 25 terabytes of total data. So you can imagine the vastness of data which is stored within the Synapse platform. And the data layer also boasts a modular architecture which ensures high efficiency, high performance, and low latency in all operations of the Synapse platform. Now I'd like to move on to the procedure of data cleaning, which happens when data is brought in from multiple resources across 100 exchanges into the 2Cents platform. So there are majorly 3 layers of cleaning across which data is passed through. Firstly, sample consistency and outlier check layer, where inconsistencies and extremities within the data are checked for and handled. Then comes the layer wherein missing data, gaps within the data are handled thoroughly, and then for each data point, its corresponding time frame is checked for. Then comes the final layer, which we like to call as data aggregation, wherein for each symbol, for each financial instrument at any point of time, data is brought in through multiple data providers and it's aggregated together, checked for at the same point in order to ensure that at each point the data is consistent and credible, so that whatever is uploaded in the Synapse platform is good to use and ensures credibility to the users. So that's about the data layer. Now I'd like to hand over to Sumit, who will continue with the proceedings. Thank you.
Yeah, so let me just quickly sum it up for all of you guys. So the three main things that you will need to understand about the data layer is, first thing is all about data quality. So second thing is data access availability, and third thing is data accessibility. So before I come addressing on all these 3 points, let me just quickly sum up what this data layer is. So we have 5 different verticals. All these different verticals has different sets of data requirements. Like our quant trading division needs more of open high low close data sets, whereas our long-term quant equity fund would need a lot more on the fundamental data and a lot of factors. So all these data gets aggregated into one single database. So that is our data layer of Synapse. So coming back to the 3 points which I mentioned, first one is data quality. So to make sure whatever data that we have on the Synapse database, we follow a 3-step approach so that the data gets cleaned complete and the data is then pushed onto the database. The second point is data accessibility, data availability. So at Synapse, we have over 25 TB of uncompressed data. So this is from over the past 20 years, right from 2010, across 5 major markets: Forex, crypto, Indian markets, US markets, and commodities. And this is on all 7 time frames, right from tick data to daily data. So you can understand the amount of huge data set that we have collected, and that is the reason why it is so huge. We have compressed it, and now it is hosted on our Synapse DB, which is, yeah, that's to sum up the complete layer. So moving forward to the next slide, now we'll be talking about the strategy layer. So now for all the different products that we have at 2Cents, the data requirements are met by the data layer. But what about the different kinds of alphas that is being developed by quant researchers and quant developers at all these verticals? So that problem is being addressed by the strategy layer. So when we were building the architecture of Synapse, we made sure to go through all the different components inside the strategy layer, and we broke them down into its minute components, and we rebuilt it completely into a modularized approach. So we started analyzing about what were the key. Everyone feels that trade is complicated, but in reality that is not the case. We analyzed on why most of the traders lose money. So there were 2 main cases on which they were losing money. One where they bet their entire position size into one single trade, and the other where they start losing frequently. Solving the first issue is pretty easy. All you wanted to know about was a basic, simple risk per trade model so that you don't risk more than 0.01% of your equity on, let's say, one single trade, and your problem will be sorted. The trickier part is on the second side where you're losing consistently, frequently. So to all that, you will need an edge. You will need an alpha. So all of us quanters, we keep saying alpha, alpha. What is an alpha? Alpha is nothing but any excess return you are getting over your portfolio's buy and hold, that is called as alpha. So to generate alpha, you will need edge in the market, be it statistical edge or be it technical edge. That edge is what we call as alpha. And considering these 2 scenarios, we came up with a 3-layer, 3-module architecture inside the strategy layer. So the first module are the different alpha strategies that we have on the Synapse. The second module is the different kinds of position sizing models, and the third module is the different kinds of trade management models. So I'll be addressing each of them one by one. So alpha strategies are nothing but all the different kinds of alphas that we have on Synapse. Position sizing models are nothing but, let's say, why should you go with a fixed risk per trade on all the trades that you're taking? Let's say even on my previous analogy, I mentioned risk per trade. Let's say you go on to risk 0.01% on every trade that you do. Why should you go with a fixed risk of 0.01% for all the trades? Instead of that, you can come up with a probability-based model that will bump up the position size for higher probable trades and dump down the position sizes for lower probable trades, and that is what we did exactly on the position sizing models. Coming back to the trade management models, here it is all about, instead of single SL and single TP, this is all about how you enter and how you scale in, how you scale out, and how you exit the trade. So I'll hand it over to Sumit to take this forward.
So, good afternoon, everyone. My name is Sumit Deshpande, a quant developer at 2Cents Capital. So I hold an immense pleasure to present you and walk you through our strategy layer. So as Nitesh mentioned, that the strategy layer stands tall upon three main strong pillars. Three main strong pillars of the strategy layer are the alpha strategies, which acts like your driving force behind each and every trade. Then we have the position sizing models, which helps you for a seamless execution as well as your capital protection. And then we have the trade management model, which helps you for getting your trades. So we'll walk you through each and every step of what each of them is. So starting with our first stop is the alpha strategies. So as I mentioned, that the alpha strategy is nothing but a driving force behind each trade. All of the models that we have created have been backed by research and thorough development, and each of them has been tested into a simulator market so that we have an immense amount of gains to our portfolio. So let's take a deep dive look into what it is. So we have bifurcated the alpha strategies into two different sectors. First is the time-based one, second is the algo-based one. In time-based one, we have the low-frequency trading. Think of it as your long-term approach, wherein you hold your trades for a longer period of time. Let's say the time duration is weeks, months, years, etc. Next, we have the medium-frequency trading, which is a perfect balance between your swing trades as well as the retracements, wherein you hold a trade for a couple of days. And then we have the high-frequency trading, which is the HFT, wherein we have rapid-fire strategies and the decision-making that you need is in milliseconds or seconds. So we have to be quick in this time-based approach. Next, we have the algo-based approach. In algo-based approach, it is purely data-driven models that we have developed upon. First is the quant-based one. In quant-based, we have developed the models based on rooted upon statistics and maths, which is our formulaic-based models. Then we have the technical-based. Technical-based are nothing but the factorial indicators that we use generally in trading, which can be your RSI, MACD, etc. Then we have the fundamental-based. In fundamental-based, we leverage the financial market data so that we could get the maximum ROI of our portfolio. So these are some of the strategies that we have worked upon in past few months, and each of them has given a good amount of ROI for our portfolios. Next comes the position sizing model. It is one of the most important element in trading while you're trading. It holds your capital, it protects your capital, so it is very important to know that what is position sizing. So I'm going to create a scenario basically. Let's say we have an ideal market and the probability of your winning and losing is 50-50, right? And suppose in a 50-50% scenario, the amount you lose in a particular trade is 1/2. Similarly, if you get 2 bad trades in a row, it is 1/4. So every time you push in 50% of your capital into a single trade, you might lose whole your after each and every trade. So it is very important to have this position sizing model into consideration, which will help you to protect your capital. So according to considering the concept, we have divided into two factors. First is the fixed position sizing. It is yet simple and effective, wherein we allocate amount of capital into at the initial stage of your trade and let it run through. Next comes the dynamic position sizing, which is depending on the market conditions and market sentiments and market factors, will gradually scale in the positions and gradually scale out the position depending upon the probability of your trade. So these are some of the position sizing models that I've worked upon in past few months. factor-based, probability-based, percentage and game edge analysis. Each of them has given a good amount of result for each trade, which can be helpful to protect your capital at each and every single step. So this is one of the example of probability-based sizing. So at the peak, you have the higher probability of a trade or likelihood of success. So we'll pump up the position sizing so that you get a maximum investment for a particular trade. And at the edges of the tails, you can see the probability is less. So we'll dump the position sizing so in order to protect your capital for a trade. Now, lastly comes the trade management model. It is yet another effective measures wherein we have to manage our trades, manage our entries into a particular trade. So how we manage our trades? Let's look at it. So this is how normal traders generally trade, wherein they look out for the position, they set a single stop loss, set a single take profit, and run through the entire trade. But what if when we have seen a retracement, we will pump the position size more in order to get maximum returns for that particular trade. So that's how we come up with the concept of trade management models, and we have developed some of these in a particular slide. So these are some of the trade management models that we have worked upon. The single TPSL, where it is a yet effective and beginner's approach. Multiple TPSL is nothing but for each and every entry in your trade, we will have multiple take profit and stop losses. Scaling in, scaling out depends upon the probability based structure. Trailing SL means you have a short lock-in profits when you trade in a particular entry. And multiple trailing SL is nothing but an advanced version of trailing SL, wherein for each and every entry, you will have multiple trailing SLs for a particular trade. Now I would like to hand over to Nitesh.
So here is the main part. So as we discussed about strategy layer in detail, now we have a lot of different alphas on the alpha layer, alpha module, and now we have over 100 plus position sizing models on our risk management model, and we have over 100% different types of trade management models on the TM model. So now we just did a small cross-grid search, which we typically do on a hyperparameter tuning, so that for any kind of alpha our quant developers come with, Synapse will be able to give you the best position sizing model and best trade management model that work the best for it. So that is to sum up the strategy layer. So moving forward to the next layer. Next layer is the processing and computational layer. So now we have addressed the concerns of data, and now we have addressed the concern of coming up with a complete strategy by combining an alpha and a risk management model and a trade management model. So now we'll be discussing more on processing and computational layer, through which we'll be doing various different types of computations and how it is throwing out various different types of tier sheets. So now I have my colleague Raghav from IIT BHU. So he is actually joining online. So he'll be taking up processing and computational layer.
Thank you, sir. Firstly, a little bit about myself. Myself, Raghav Singh, a senior grad at IIT BHU. I work as a quant developer at a beloved 2Cents capital firm. I am responsible for building the testing framework that is used by the firm, and I shall be guiding you guys through the intricacies of the processing and computation layer of the Synapse platform. The processing and computation layer is designed to turn strategies into success, from hyperfast backtesting to parameter optimization to cross-validation. The layer packs it all. Next slide, please. Here is a list of all the features the layer provides. A lot of fancy terms here. I shall now show some of the most important ones. Next slide, please. Modularized approach. The entire layer follows a modularized approach, keeping in mind the convenience of the strategy makers. So we have multiple assets, we have multiple asset classes, and also we have multiple time frames in our data. The layer allows us to pick any asset or any asset class, any time frame, or even bunch of time frames. Thereafter, the layer will automatically fetch the data from the data and perform the desired functionality on it. That is how it is. That is how it is. Now, this desired functionality processing and computation layer, we can perform extensive strategy backtesting. Now, what is backtesting? So the layer receives a trio of alpha risk management model. This makes sure that we are making the best use of the data that we have readily available. Now, as we can see, backtesting can be two flavors. It can be event-driven or it can be vector-based, both being awesome in their own way. Could you show the previous slide, please? When we want backtesting results to be extremely accurate, we go for event-driven backtesting. This will execute the strategy tick by tick on the historical data. On the contrary, if you want backtesting to be hyper-fast, go for vectorized backtesting. As you can see here, once the backtesting wraps up, we will be able to see how our strategy performed, how it took trades, basically all possible performance metrics. My friend Arpit will detail more on these later. Next slide, please. Firstly, backtesting is followed by the phase of hyperparameter optimization, as you can see. Basically, every strategy has a bunch of parameters involved in it, for which the appropriate setting is not known yet. For example, Subir gives me a basic SMA crossover strategy wherein I have a short SMA and a long SMA. How to decide the values of this? That is where the hyperparameter optimizer kicks in. This will run the strategy in parallel for all possible settings and thereby showcase the performance for each of those settings. I'll give an example. As you can see from the heat map, short SMA is shown on the y-axis and varies 10 to 90. Long SMA is shown on the x-axis and varies from 40 to 140. For each layer, heat map is showing how the Sharpe ratio varied. As we can infer from the heat map, the setting when short SMA was 50 and long SMA was 70 generated the best results. Instead of Sharpe ratio, we can choose some other metric as well. Again, modularity as I discussed earlier. Now I know what you guys are wondering. This can overfit, right? We are setting the parameters to perform well on the historical data. What if it doesn't generalize well? But bear with me. Walkout optimization will take care of this as well. Walkout optimization is one of the validation techniques the layer offers. To put it into simple terms, walkout optimization divides the historical data into testing and training chunks. The animation shown here showcases that really well. So for example, I tune the parameters on the first 3 months of data. Thereafter, I will test this on the next month of data. I shift the window by a month and repeat. The first iteration will train on the first, second and third months and find the optimal setting using the hyperparameter optimizer. Thereafter, we test on the fourth month with the same setting. In the second iteration, we train on the second, third and fourth months. Thereafter, we test on the fifth month. The entire process repeats until all the data we have is utilized. So now, by checking the performance of the strategy on the testing data, I will be able to determine if a strategy is generalizing well or is it overfitting. And this will give me the best parameter setting based on such local optimizations. Pretty neat, right? Next slide, please. Alright, so I get the strategy, tune its parameters, check for overfitting. Now, we must definitely go live, right? I guess you guys must be wondering that only. Not quite. Synapse offers yet another layer for final testing before going live. You know, some extra risk mitigation doesn't hurt anyone. That is what the simulation layer offers. As you can see, the simulation layer is all about simulating markets and paper trading. I'll detail more on these now. Next slide. Market simulation allows us to test a strategy on custom market conditions. So let's say you want to test a strategy in conditions mimicking the COVID crash, or for example, the 2010 flash crash, or low liquidity conditions, or sudden volatility spikes. The simulation layer has it all covered for you. Or better, if you don't even know what kind of condition to simulate it in, just use a Monte Carlo simulator. This will create a randomized version of the past market for you for the purpose of testing. As you can see, simulation layer is all about extreme stress testing. We can identify the pros and cons of a strategy and use them to our advantage. As simple as that. Next slide. Finally, once all of this is sorted out, we have the final testing stage, paper trading, or fancily termed as forward testing. In forward testing, we run a strategy in the live market conditions. Actual capital is not utilized, but the actual order filling price and the trades, both of those are fetched from a live broker. And as you can see, this can be Bybit, this can be Zerodha, this can be MetaTrader, etc., etc. Thus, we can clearly see if a strategy is fit for the current market or is it not. Only if it is, we go live with it. I hope I've convinced you guys that any strategy passing through such rigorous testing is destined for greatness. That is all from my side. Over to my friend Arpit now. Have an awesome day ahead. Thank you for listening so patiently.
Yeah, thank you, Raghav. So one critical infrastructure of the processing and computation layer is it is not only about doing backtests and hyperparameter tuning, but whatever the same piece of code you can directly connect through brokers and you can directly connect it through layer so that you will be able to run it on a simulated environment. So now you can see the value of quant developers working on a single class which has their alpha, and then they get access to all these different kinds of features that is very much required to refine their alpha and test their alpha on the live markets. So now let's move on to the next layer. So this is the tier sheet generation layer. So whatever computations were done on the previous layer, all needs to be generated as tier sheets so that quant developers will be able to analyze them properly. So now I have Arpit with me. So he'll be taking you guys through the complete architecture of the tier sheet generation layer.
Hi everyone, I am Arpit. I am from Computer Science Department, IIT Delhi, and I am working as a quant developer at 2Cents Capital. So today I will walk you through one of the most important component, that is tier sheet generation layer. This layer acts as a analytical backbone that transforms our raw data into actionable insights. This layer focuses on analyzing strategy performance metrics like equity curves and trade statistics. It helps us identify patterns, trends, and examine correlation with other market factors. It produces detailed yet concise reports which help us to evaluate strengths and weakness of the strategy. This layer acts as a bridge between the trader and the data to help to refine their strategies, manage risk, and evolve according to changing market conditions.
So the multi-level tier sheet generation layer generates 3 levels of tier sheets: level 1, level 2, and level 3. So level 3 is all the basic risk metrics that is coming out, right from your return to Sharpe ratio to Sortino ratio. There are around 30 risk metrics that is coming out of level 1. Level 2 is all about the equity curve, trade book, and rolling window analysis. Rolling window analysis is nothing but all the different metrics that are coming out of level 1. Let's say you monitor it over the entire period of time. So that's your rolling window analysis. If you just look at an alpha and if you see a Sharpe of 1.4, you will not be able to conclude that if it's a good alpha or a bad alpha. Instead of that, let's say you have the chart, the entire Sharpe ratio. So you can see when it spikes up and when it spikes down. So that is the rolling window analysis that we do on level 2. Level 3 is more about strategy persona profiling, and we tear down the equity based on macro factors. This is more about understanding what are all the strengths of the alpha and what are all the weaknesses of the alpha so that we could run them on those particular market conditions.
Now let's discuss each level one by one. Starting with level 1, that is risk metrics and trade performance. This level gives us a quick snapshot of how our strategy performs using the past data. At this level, we can use various kind of metrics to study about our strategy. For instance, using metrics like win rate, Sharpe ratio, and drawdown, we can figure out how well our strategy manages its risk and the reward. This level acts as a quick reference for the trader to analyze if this strategy is even worth going deeper or not. Now let's move on to level 2, that is trade book and rolling window analysis. At this level, we study our strategy at each trade level. Trade book is a document which contains metrics like timestamp, buy and sell price, asset traded, and what was its P&L contribution. Using trade books, we can find out many kinds of different insights, like we can pinpoint some slippages or suboptimal execution times that directly affects our profit. Trade books also act as a way to check if our implementation of the strategy is same as the intended one. Now, now let's discuss the rolling window analysis. This tracks how our strategy evolves over time using the sliding window of data, and it lets us know, like, in the condition of market stress, it reveals whether our strategy shows stability or vulnerability. It helps us in the risk management. Now let's move to level 3.
Yeah, so this is the level 3 tier sheet which I talked about. So let's say now you have the equity curve of an alpha and you are able to compare the equity curve with the different types of factors that you have in the market, so that you will be able to understand at what kind of market condition it is performing good and what kind of market factors it is performing bad. So that is the persona of the strategy, and the drawdown behavior is nothing but at what kind of market conditions are we experiencing huge kind of drawdowns and how it is impacting the equity curve. Seasonality patterns is all about, let's say one particular alpha may work on certain months or certain days or on certain hours of the day. So all those kind of seasonality patterns we monitor through this particular module. So these are all the different things I mentioned on the persona of the strategy. So we have the equity curve at the top, and at the bottom we have 3 curves. First is the technical factors, second is the emotional factors, and third is the fundamental factors. So now when you map it along with the equity curve, you will be able to clearly differentiate that at what market conditions they are performing good and bad, and that is how we identify the persona of the trading strategy.
Now let's discuss the drawdown behavior of the strategy. This lets us find out what is the strategy's resilience and its risk curve. This lets us to pinpoint certain kind of market conditions in which we can make huge losses. For example, spikes in the volatility curve. To address this issue, we use various kinds of risk mitigation techniques like forward testing, hedging, and dynamic position sizing. This lets us make our strategy bounce back faster and maintain its consistency. Our goal is to build robust strategies that will work well even in challenging conditions. Now let's discuss seasonality patterns. These are recurring trends which are influenced by time that may lead to growth of some certain kinds of stock. To analyze these patterns, we plot different kinds of heat maps like hourly returns heat map, weekly returns heat map, and monthly returns heat map. Using these heat maps, we can find out at what exact time period our strategy performs good and what exact time period our strategy performs bad. This will let us to take maximum advantage of the opportunity.
Yeah, so this is the summary. So you have the equity curve, the drawdown behavior, and the seasonality patterns, and using that we roll out all these 3 different tiers of tier sheets, which is able to drive us with all these insights. So once we completed the tier sheet generation layer, all the local systems that we had were not able to handle the huge computational so that sparked us the idea of pushing TradeMaster to cloud. So the next layer you will be seeing is the distributed computing layer. So my colleague Praneeth will be explaining about the distributed computing layer.
I am a computer science engineer in VIT, and I am working as a quantitative developer in 2Cents Capital. So here we are having the detailed architecture of distributed computing layer. It has basically 3 main blocks. First one is development environment. Under the development environment, we have workspace management system, which is basically responsible for the flexibility and the isolated environment, which is required by a particular algorithmic developer. And this system is further connected to the bare metal server, which is responsible for the raw computing stuffs. All these things are orchestrated here through our container orchestration part. Further, we have the execution and reporting block, which has basically 2 major components. First one is backtesting engine, and another one is tier sheet generator. Backtesting engine is basically responsible to process the test scenarios in real time. After that, we have the tier sheet generator part, which is used to automate the generation of the tier sheets, or we can say that comprehensive reports on the basis of the backtesting results we have on a particular algorithmic strategy. Both of these components of execution and reporting part is then stored into the secure storage system, which is under the support service block. Along with secure storage system, we also have user authentication and management part in the support service part. Now I would like to expand the execution and reporting block in a much more detailed manner. So let's move on to the next slide. which has the architecture of execution and reporting hub. So it looks like complex, but let us simplify it a bit through layer by layer. So we have input layer at the first part, which is responsible to reproduce the test scenarios through a user-friendly UI or APIs. Further, moving to the core components part, it consists of several features like scalability, which is mainly responsible to handle the increasing data volumes. After that, we have the visualization and configurable template stuffs, which is used to make the insight easily interpretable. Along with that, we also have the market data integration feature, which is used to have real-time and historical data. Now moving on to the result processing part, which I have already explained to you in a bit detailed manner previously in the detailed architecture of data and distributed computing layer. Now these generated reports is further stored into the secure storage system, which consists of data encryption, access controls, and high availability. Now finally we have the integration layer, which has external API system, which is used to share the data across the platform. And also we have the collaboration tool connectors, which is used to enhance the productivity of the team. Now I would like to move on to the basic workflow of the Synapse platform we have right now in the next slide. So here comes up with the basic workflow. So now I would like to start with user login slide. Here is every journey is started with user login, which is used to access the platform, and just start with the trading execution we have to do after the user login. Now we will be moving on to the create custom workspace, which basically provides you the environment which the way you like to manage it, and basically the tools you have to integrate in that particular workspace that this function provides you. Now we will moving on to the collaborative environment, which is present under the workspace part, which leverages you to work together to your team in the way you like, and just share ideas, strategies, and workflows to make the particular algorithmic strategy that your team is designing more productive and efficient. Now I will move on to the simulate part, which is basically what we can say used to test our algorithmic strategies on the virtual market. It's like experimenting before diving into the real market. Now finally we have the live trading part, which is where you are going to step into the real world, backed by all preparatory steps you have taken for making the algorithmic strategy more optimal and productive. Now I would like to show you like what we have done so far in distributed computing layer. So first one we have done, we have the high performance infrastructure, which consists of a bare metal server with big amount of storage in it. Along with that, I have seamless collaboration workspaces as well, which has the cloud development environment for an individual who is developing his or her algorithmic strategy. After that, we have the consistent backtesting stuff, which has Docker containers, where basically it ensures the scalability, isolated environment for the development and the production stuff. Along with that, I have insightful reporting part as well, which has detailed HTML tier sheets. It is a bit more explained by my friend Arpit in tier sheet generation layer already. So let's move on to the final scalability and security part, which is mainly responsible for the load balancing and auto scaling stuff. So now I would like to conclude the distributed computing layer of Synapse, and now I would like to hand over the further parts to Nitesh sir. Thank you so much and have a good day.
So this is the final layer that we have on Synapse. So all the different layers that you can see here are the data layer, strategy layer, computational layer, and tier sheet generation layer. So once we have established this architecture, and once we completed building this, we want to take it to the next step. So to do that, we integrated them with AA agents. So this is the roadmap for Synapse for the next 6 months. So what we are planning to do is, for the data layer, we are planning to have a separate data AA agent that is able to source the data from various markets and then store them on the Synapse database. So that is the sole purpose of the data layers AA agent. Similarly, we'll have 3 AA agents on the strategy layer, one to generate alpha, one to generate risk management models, and one to generate trade management models, and one that performs a cross-grid search, and then it is able to give out the final strategy with the best set of alpha and best set of RM and best set of TM. And we'll also have an AA agent for performing all these different sets of computations and generating the tier sheets. So the portfolio manager AA agent would be reviewing all these results, modifying the alpha, and then rerunning the complete loop again. So this is what me and my team are going to work on the next 6 months, and this is our roadmap for Synapse. Yeah, so this is a graph which I explained right now. Yeah, so thank you so much guys for listening so far. Have a wonderful evening again.
Thank you. Okay, thank you very much, Nitesh. Okay, so that concludes all the presentations for the day. I thank you all once again for taking the time out and coming here. I would now request you guys to kindly proceed for a buffet lunch that has been arranged in the corner. Thanks once again. Thank you very much for coming. Thanks a lot. Bye.